We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is John Adams and David Morgan. We have a kind of a special presentation here for you, and we're going to talk about the issues kind of related to the Perth Mint. John has some very interesting stuff to bring up with us. And David, you actually retweeted an article recently by Craig Hemke, and in it, he was writing about how the defaults related to the silver squeeze movement will likely start in the unallocated accounts that are run out of Perth, Montreal, and Zurich. So, John, why is this, or what are we seeing out of the Perth Mint? Why don't you bring us up to speed on that for those that, let's say, don't know, and why is this so significant?
Sure. Okay, so Tom, what I want to do is I want to take about I want to go through a bit of a timeline. Mm-hmm. So here I am talking to you from Sydney. Obviously, Perth is I'm on the east coast of Australia. Perth is on the west coast. So late February, I was hearing anecdotal stories from contacts of mine walking into the Perth Mint, looking for retail product, and was told no silver for sale. Now, I think we highlighted in our last conversation on your show. I work for As Good as Gold Australia, which is South Australia's largest bullion dealership. We are a accredited distributor for the Perth Mint. Starting in March, we were told we cannot place an order for silver on the Perth Mint. And we were not the only retail bullion dealership in the country. Retail bullion dealerships across the country said you cannot order silver. I've spoken the last few days to an Australian wholesaler in the precious metal space. He also said he can't get silver out of the Perth Mint. Now, starting about last Friday, I had an email from a person in Perth, and I straight away called this person on the phone. He said to me that he placed an online order 24 hours ago before for 20 kilos, and he was told 4 months wait to get 20 kilos. Now, if a person came to my company or someone came to one of the other private sector providers in the Australian market, we can pretty much supply 20 kilos on the day. Now, if there was any sort of inventory problem, maximum a week to 10 days, not 4 months. So that was highly unusual that the Perth Mint would say to a customer that it would take that long. So that's about placing a new order if they're willing to accept your order. Now, when it comes to these, what I call synthetic positions, which is unallocated and pool allocated in the context of the Perth Mint. Now, I've been on a campaign, and I've been leveraging David's work as well as Craig Hemke and a few other people about the importance of owning physical silver where legal title can be established. So when you go to a bullion dealership and you buy, for example, a bar or a coin, that is your legal property. That is what you own. You have legal title. If you store that in someone's vault, that's what they refer to allocated. So someone's holding it for you, but it is still your legal property. Unallocated and in the Australian context, what they call pool allocated, these are effectively promissory notes where they basically say to you, for a lower fee structure, and in some cases no storage costs, you can have exposure to gold or silver. And what you're doing is you're buying a interest in a pool of gold or silver. So in the context of the Perth Mint, unallocated refers to their working stockpile of gold and silver that they use for production. You're buying an interest of that. When it comes to pool allocated, they're basically saying we've got a warehouse full of 1,000-ounce silver bars, and you're going to buy a portion of that. But rather than actually legally owning anything, you're just going to buy a share of that. In the context of unallocated, pool allocated, you have counterparty risk because you technically legally don't own anything. Basically, you buy these things on the expectation or the promise that your counterparty is going to give you the benefit of a fluctuating price, or if you want silver or gold, that when you want it, they're going to give it to you. Now, the Perth Mint website is categorical. If you have an allocated account, it says clearly deliverable in 2 days. If you have unallocated or pool allocated, deliverable in 10 days. Now, the official narrative of the Perth Mint is that they have 60. So this is a quote from their CEO: 60 tons ready for sale, available for sale. If anyone wants it, anyone can get it, but it's in 1,000-ounce bar form. They have some fabrication operational problems, and they are struggling to melt it down into smaller products. So I can reveal that about a week and a half ago, with As Good as Gold Australia, we closed a significant deal with a client, multi-million-dollar deal in the tons. Now, he had unallocated the Perth Mint. He started getting nervous about his unallocated position because he was hearing on shows like yours about shortages in the global supply chain. And he read my work, and we've been talking for about 6 months. And he said, okay, now I think it's time to change from unallocated to some sort of allocated position. He started entering into commercial negotiations with us to see what sort of deal we could do for him. But I can say the straw that broke the camel's back was he went to the Perth Mint and said, 3.5 tons, how long will it take for me to get it? I want you to give me a hard guarantee. No hard guarantee was provided, and that was enough for him to liquidate his position and come across. Now, we have had a range of small clients with small positions looking for coins or bars who have tried to stand for delivery, and they have been told that they have to wait in a queue and they basically can't deliver within the 10-day time frame. So last weekend I put out a tweet, and to be honest, I thought the tweet was only going to be seen by a few people. As of this morning, the tweet had 360,000 impressions, so it went worldwide. So and in that tweet I talked about the Perth Mint, horror story after horror story, and I said that people are struggling to convert from synthetic to physical. And that the Perth Mint has defaulted. So the default I referred to was their promise around about delivering silver in terms of a respectable time frame, consistent with what they say on their website. Now, their excuse is obviously we have an issue with small product, but we have 1,000-ounce bars. Now, I have a friend last weekend, 200 kilos unallocated the Perth Mint. He didn't believe me. And he thought I was sort of exaggerating what was going on. So I said to him, why don't you call the Perth Mint on Monday and find out what's going on? So he calls them up Monday morning, and he says, okay, I have 200 kilos. I want to go from unallocated to allocated. And they said, sorry, we can't do it for you. We have no silver. But then they did say, we have some silver coming in the afternoon. We don't know how much is coming in. If we have enough to fulfill your request, we'll call you back. Monday afternoon came, he didn't get a call. Now he called on Tuesday, and basically what he was told was, well, we now have some 1,000-ounce bars available. If you want to purchase 6,000-ounce bars and pay the fabrication cost, which is about $1,000 Australian per bar, we can do the deal. And so that happened. And so he snapped up 6 of them. Now I have a client, interestingly enough, on Wednesday, who had 10,000 ounces unallocated, and he sent me a couple of long emails, and I spoke to him on Wednesday night. His situation is he had unallocated, he asked for physical, sorry, no silver. Mm-hmm. Then he said, okay, can I go from unallocated to pool allocated? And they said, sure, you can do that. You pay 50 cents per ounce fabrication costs. So he did that. He converted 3,200 ounces from unallocated to pool allocated. And then from there, he says, well, now that I have pool allocated and this product is backed by 1,000-ounce bars, how about you give me 3,000-ounce bars? Sorry, we can't give it to you. Well, why not? Apparently, these 1,000-ounce bars are placed in different categories in the warehouse, and your product doesn't fit the categories that we have, or some BS like that. Now, I was befuddled when I was told this, and this guy who told me on the phone, I said, well, what does that mean? Do you understand this? And he goes, I have no understanding. And so clearly for me, they say we have 60 tons of 1,000-ounce bars. Wholesalers cannot place. I have a wholesaler today. He's ready to buy 1 ton of 1,000-ounce bars from the Perth Mint, ship them across to the east coast of Australia to another refiner, melt them down into retail product, and then go sell into the retail market. The Perth Mint is unwilling to sell to him. I have heard, now, there are some days where people can snap up 1,000-ounce bars. There are other days, like this person who called me on Wednesday, they are being told for whatever reason, there are no 1,000-ounce bars. Now, it is interesting that I should say that because I put out this tweet, and it got a lot of attention. I mean, when the CEO of the Perth Mint was interviewed by the Australian Broadcasting Corporation on local radio on Perth, the conversation was framed about a default. Now, I was the first one to use the word default, and then it spread like wildfire. So maybe it was my tweet that placed pressure, and they were sort of trying to scramble to find some sort of supply to fill some of the backlog on Monday afternoon. But what I can say to you is that I have had a whole host of customers of the Perth Mint, either placing new orders or who have synthetic positions, who are having trouble to get silver out of the Perth Mint. And in a number of cases, these customers are liquidating their positions and going to other providers in the Australian market, my company and others, looking for physical because they want to eliminate counterparty risk. Because I've been doing a number of shows around the world on YouTube highlighting the risk of these products.
Mm-hmm. So, John, does this also kind of these, let's say, synthetic products or unallocated or pool allocated, does that really kind of highlight as well the chance that these could be, really a fractional reserve system of selling silver to multiple parties kind of thing?
Sure. So the Perth Mint on their website say that their synthetic products, unallocated, pool allocated, is 100% backed. Mm-hmm. So if we have exposure to 100 tons, we have 100 tons sitting physically somewhere. That is the public perception. And that has given a lot of investors confidence that if they place their money in a synthetic product, that they have that exposure, and that it is backed. Mm-hmm. Now, what I have been able to reveal over the last few years is that, on a separate front, I've been investigating the Reserve Bank of Australia. They have leased 11 tons of gold, and we have 80 tons of gold as a country with our central bank. It's sitting in the Bank of England. 11 tons of the 80 tons has been leased. Now, and I did a number of shows about this on YouTube in 2018. Now, by February of 2019, the Reserve Bank of Australia testifying to federal parliament, a number of the parliamentarians asked questions about gold and gold leasing because one, they saw my show, but two, I used to work in a previous career in federal parliament, so I was able to brief a number of parliamentarians about this. And the quote from the Reserve Bank of Australia on the record was, well, when we lease gold, the gold physically does not move. And initially I thought, well, how would they know that? In 20 years, at that point in time, they only ever were in the vault once in 20 years. So how would they know? Because there are allegations, and Eric Sprott has been on the record as saying he believes, and other people in the gold market believe that, no, the gold actually does move out of the Bank of England to the bullion banks, melted down in Switzerland, and they've been sold into India, China, and Russia in order to suppress the gold price. And they're using leasing arrangements to basically keep the gold price under suppression. But taking the assumption or taking the statement of the Reserve Bank of Australia on face value that the gold does not move. Well, what was revealed through a Freedom of Information request in late 2019 was, so two RBA officials were corresponding back and forth. And it was revealed in that correspondence that the person who borrowed the gold from the RBA was the Perth Mint. Now, you have to ask yourself, if you are a manufacturer and a retailer, why would you borrow gold, 11 tons of gold, from the central bank in a foreign vault, which the central bank told Parliament does not move? The only justification that I can come up with is they're using these leasing arrangements to provide backing to their synthetic product. So when the auditor walks in and says your exposure for a synthetic gold or silver product is, say, 100 tons, show me the 100 tons. And part of that accounting is using leasing arrangements to come up with in terms of the backing. Now, so the corporate name for the Perth Mint is called Gold Corporation. If you go to the Perth Gold Corporation annual report for 2020, look at the balance sheet, you'll find a line item under current liability says precious metal borrowing interest bearing. And that, as of 30 June 2020, is $1.7 billion. So they've borrowed $1.7 billion through leasing arrangements around the world. Part of that $1.7 billion is the 11 tons of the RBA, but then there's potentially other gold and silver holdings that are part of that. And so the question is, well, if you're a refiner / retailer, and you're borrowing gold through leasing arrangements, what for? The only thing I can come up with is it's these synthetic products, and that's how I am on the record of saying the Perth Mint is running a fractional reserve synthetic program, which is not transparent to the market. Now, if I'm wrong, I'm happy for the Perth Mint to come out on the record and say, why have they borrowed 11 tons of gold from the Bank of England, from the Reserve Bank of Australia, sitting in the Bank of England, that the RBA told Parliament does not move. It doesn't make sense otherwise.
So there's also some other reports, John, that are saying that the Perth Mint is telling customers that it is purposely slowing fabrication. There's also, another report that you tweeted out about ABC Bullion having spoken to one of their customers by phone about not being able to deliver her supposedly securely stored metals. The Royal Mint appears to be struggling to keep up with demand, and also the US Mint is canceling orders. So what is this kind of like, are all these things related? Maybe David, how about you jump in here and tell us how these things are related?
Yeah, what I'd like to do is to kind of take a step back and give a brief history of how this all started. And I think John did an excellent job. I'm going to try to simplify it a little bit. So we go back to the very, very early days of banking. The goldsmiths basically were the ones that kept the gold. And the goldsmiths would hand out a receipt to people that owned the gold, and they had a one-to-one correspondence. Everything was basically in a segregated account. And what the goldsmiths noticed after some time was that roughly only 10% of the people ever came back for their gold. Rather than the people exchanging gold for a product or a service, they just exchanged the receipts. So they, or maybe not all of them, but some of them decided, well, we'll just print up some receipts and make ourselves richer. So they basically turned a segregated account into an allocated or a pool allocated account and started issuing a lot of more receipts than the gold available, somewhere around the 10-to-1 leverage, because they knew about a tenth of the time people came back. And then one day, one townsperson saw the inflation, these guys are really spending a lot of gold. I wonder if they've really got that much. I'm going to go get my gold. And that was the first bank run, because these people came with their receipts and said, I want my gold. And there were a heck of a lot more receipts than there were gold available, because the goldsmiths had basically cheated the people. That's a brief analogy for how it all started. It's in the record. You can read it almost anywhere if you do a cursory study on the gold market. So back to where we are now, I don't have a lot to add to what John said, but I will say this has happened in the past. We see one of the rules I wrote in the 10 Rules of Silver Investing was, don't get a raw deal from your dealer. Just because you have the lowest price doesn't mean you're getting the best deal. And I see this all the time. I mean, even people with millions of dollars will worry about, a quarter point on storage, or, 5 cents on a bar or something. You want to deal with the best of the best. I do work with As Good as Gold Australia as well as John. And, there's some dealers that you just, you got to be careful. And what I teach, because we don't know, and any newcomer, I'm okay with a new business, I always say start small. If you're going to put $1 million in the silver market, buy 1,000 and see how you're treated, and see if the product comes, see how it's packaged, see how long it took. Mm-hmm. You don't want to bet the farm on something you really haven't tested. Now, if you're going to go to As Good as Gold Australia, or maybe some of the other dealers in the US, you're going to be fine. So I want to kind of leapfrog from the gold story into the silver story and add something that John's probably spoken with Craig Hempy about. But Sprott has a filing now on the books that would roughly buy 100 million ounces of silver at today's price. And I think that's enough to bring this thing to exposure, meaning that amount of cash turned into currency, turned into money, turned into silver, would basically, round numbers, deplete the SLV mm-hmm. and put that same amount of silver into the PSLV. Where, from my studied opinion, there's a lot of shenanigans with the SLV. I did a whole subsection in the Morgan Report last month about it. But regardless of that, we're going from the SLV iShares to the PSLV with the same amount of silver. Mm-hmm. So if and only if all of that silver is there and it moved from one hand to the other, basically it shouldn't cause any kind of disruption. However, if it's become a fractional reserve system, which in my strong view it has, I did a whole section in the Silver Manifesto on fractional reserve bullion banking, that would cause a huge disruption. So those are my two main points. I'll turn it back over to you, Tom.
So guys, how big could this problem really be? David, you kind of mentioned that there's examples of this happening in the past. There's the Morgan Stanley lawsuit case. There's the UBS case, and there was also the Northwest Territorial Mint scandal in 2016. So, David, can you tell us a bit more about that particular mint scandal and what happened when they did actually default?
Well, the Northwest Territorial Mint is one that David Smith, that works with me, has been to many, many times. And we're both a bit suspicious because he was known as the slowest delivery of all the major mints. And he had a very large private mint. I've been through it 3 times. I've been in the vault. I've held big gold bars and all that. But we were always suspicious because if you're on the up and up, normal deliveries, couple weeks maybe, worst case 3, but not 6, not 8, not getting a letter every other week saying we're sorry, we're backlogged and all this kind of stuff. So he also was one of the most heavily advertised mints. And that costs money. You just don't put out these huge ads without paying for them. Mm-hmm. So I had suspicions around it, but I bought a few times from them. And, these guys are pretty savvy. I mean, if they see a name of a major broker dealer or they see a name of someone that's in the public eye, that order is going to get filled and probably get filled promptly. But someone that isn't well known, they might be way in the back of the queue. So as things started to deteriorate more and more, it basically defaulted. And so I have one of my, I'll say top clients, lives in Florida. I won't give his name out, but Northwest Territorial Mint advertised, I think it was a 10-ounce bar, and it was just pennies over spot. It was really a super good deal. And he called me and said, I'm going to buy all the silver. I think I got to do the same thing. And I said, no, I don't trust him. Unless over the counter, I'm not interested. So he put in several $1,000s, and of course the thing blew up, and he's got his letters and still hasn't been resolved to this day. And I'll make a statement that's a general. So that's kind of the bottom story on that. You could read more about it on the internet, get more details. But here's the deal. If every ounce of silver that was purchased by people that got frauded was actually in their hands, we would have a different silver market today. Mm-hmm. And what John's doing, and I tip my hat to him, is he's saying everybody that's bought silver on a synthetic or pool account or maybe an allocated situation that supposedly guarantees delivery, just ask for what they paid for. We might have a situation that's untenable. My contention is that if we had, the unbulkiness of silver, in other words, everyone that bought it actually took delivery for the first day that they bought it, we wouldn't have this problem today. We might have it, or let me reframe that. We'd have it resolved a lot earlier than now, because the problem continues to get worse and worse and worse. The problem is that you can take this same pile of silver and retag it between banks or sub-custodians or authorized participants, and it's a shell game. You don't know what's going on. They take the auditor into the LBMA and point to a great big bunch of pallets with these huge silver bars on there and say, look, that's JPM, and then they take the next one in and say, yeah, oh, that's HSBC, or whatever. I mean, and I'm not saying they're actually doing that. I'm being somewhat funny, but somewhat serious. What I'm trying to explain is that the tracking mechanism is not at the level where you know exactly, unless you're really able to dig deep, if that bar has been hypothecated once in a lease program and sitting on the shelf, or that bar has been leased once on and not leaving the shelf, and that bar has been rehypothecated by another bank as collateral for a loan for, let's say, a precious metals dealer, and that same bar sitting there hasn't been rehypothecated one more time to someone that's actually going to take the metal and make silverware for their product line. So right now, the cover ratio on the silver market, the last time I did it, which has been about a month ago, is about 3-to-1, which isn't really that bad, which means that for everything that's promised, theoretically promised, there's only 1/3 of an ounce of silver available. That's straight off the COMEX. That's the only one I looked at. LBMA is a little fuzzier to get a determination on what's really there and what isn't there. They're more opaque than the COMEX is. My concern is there's a lot of paper silver flying around. I think a lot of people have got to shoot those birds down, gather them up, take them home, and start counting what's real and what isn't real. And at the beginning time, we talked about what my retweet of Craig's article. The default thing is a very big game of semantics because the legal eagles that make these contracts are very specific. I mean, and John's done a great job on this as well as others. When you buy a COMEX contract, you're buying a COMEX contract. Mm-hmm. That's what you're buying. And there has a value to it. And that value is called the spot price. But in reality, the ability to trade that thing in for real silver happens about 1% of the time. It's more of a showroom than it is an actual delivery mechanism. It's not set up to be a delivery mechanism. It's actually, most of the vaults in the COMEX are set up as depositories. The Delaware depository is a prime example. I think 90% of the silver that's in the Delaware depository is in the eligible account, which means it's paid for, it's resting on shelves with a bar number, and it's segregated for long-term investors that believe that silver is going to go higher in price. So I won't say much more. I think we're kind of beating this thing to death, but it needs to be. So my final point is this. The biggest funds, let's say the iShares, the Aberdeen Trust, some of these big pool accounts, perhaps Perth, these people legally got these wiggle words that say, well, we cannot default. We'll just print our way out of it. So in a court of law, even if they brought me in as an expert witness, I would have to say, by the contract, they haven't defaulted. Now, that's ridiculous as far as have they defaulted. Of course they defaulted. Mm-hmm. If they can't produce the silver and put it in your hand when they say that within 10 days that you can have it, they have defaulted. But nonetheless, there's a lot of intricacies. Another thing that I'll set the record straight on, and believe me, I don't want to sound like an apologist for the COMEX, but after like a 5-year run for the second or third time, they said, we didn't see anything here. That's what you hear on the internet. Actually, what they said was we didn't see enough here to pursue it any further. There's a difference there. They gave themselves, again, a little wiggle worm. They said wiggle room. They said, well, we looked it over and we saw some stuff, but it wasn't enough stuff for us to do anything more. Of course, later on, they come up and basically put JP Morgan under the RICO Act, which is the harshest situation available. And I could go on. I want to do my rant probably later. Probably should hear back from John. He could comment on what I said or add to it or subtract from it. But very, very upsetting to me from day one, because I knew from the beginning that if you went to a great big stadium, like, I don't know what it is in Australia. I've only been there once, but if you go to like the Rose Bowl in the United States, pretty big 100,000 stadium, and you drew a line down the 50-yard line and you put all the silver in the world on one side of that 50-yard line, and you put all the paper receipts for silver on the other side of that 50-yard line, there's a huge, huge mismatch.
Absolutely. So, David, exactly as you're saying, that those contracts can be settled in cash, right? So, right. John, anything else to add there? I know you recently tweeted, you were saying that the wording of the government guarantee is only cash settlement, not metal delivery, which is a Perth Mint own addition. And it looks like the customers may already be activating it. Could this bankrupt the Western Australian government? So what are some of the possible downstream effects of this?
Sure. Yeah. So, I mean, look, I've never suggested that the Perth Mint was going to be going into some sort of financial insolvency or anything like that. But look, I've probably a couple of points to make. The first one is about what David was referring to in terms of the investigation into the silver market. So the interesting thing is that there is a interview between Chris Marcus and Bart Shilton, and that was documented in Chris Marcus's book, The Big Silver Short. And I've listened to the YouTube version of that. And Bart Shilton is on record of saying was that they had evidence of market manipulation a decade ago, and there was political pressure not to pursue it. So while David says there was some evidence, but not enough, Bart Shilton, who was a CFTC regulator, basically saying they got told from someone to stop the investigation. So that's probably point one. Point two is that a number of silver experts like David have gone out in numerous publications and interviews and said that for every 1 ounce of silver available, there's at least 500 to even 1,000 claims. And actually, in Chris Marcus's book, in the chapter where Chris interviewed David said that the claims could be up to 1,000 claims per ounce. Well, how do you get to that situation? It's through these leasing arrangements, rehypothecation, double accounting, triple counting. I mean that's how we build to this such enormous leverage position. The third point I'll make is that I sort of came into looking at the silver market. Now, I've only been in this sort of sector for a few years, whereas David's been basically his whole life's work. What I've learned is that given we know that the price is manipulated, there's no point looking at the price and trying to understand where this market's going. What you have to do is you have to look at the physical silver in the system and figure out where that silver is going, in what quantities and why. About a month ago, or maybe 3 weeks ago, I wrote an article on my Adams Economics website, and I said that the silver market is fast approaching breaking point. And basically, what I was saying was, since the silver squeeze, you were seeing stress in the physical market. So retailers in North America are getting cleaned out. Premiums on wholesale bars are going up. SLV changes its perspective. Base leasing rates are going through are actually they're going higher, showing that it's actually tougher to borrow metal in London. Then obviously with the COMEX, the warehouse inventories peaked on the 2nd of February at 399.7 million ounces, and in the last 6-7 weeks, about 29 million ounces has come off the COMEX through a whole host of deliveries. Now, my contention is that, so there have been some people out there saying we need a big whale to come in with a huge amount of demand to really place a lot of pressure on COMEX that they've got to force the price up, because there's just not enough silver to meet these delivery contracts. So people refer to Warren Buffett or Elon Musk or Apple or Samsung or Tesla or a whole host of these companies. My contention is that, for example, in the last month of waging this campaign, and like I said before, little old me, I'm no one. I've converted 14 tons of synthetic to physical. Well, the fact that people have taken possession of 14 tons of physical silver, that means that 14 tons can't be used for ETFs. It can't be used in London. It can't be used for COMEX deliveries. So the importance of what I'm trying to achieve is, if everyone in the world who has a synthetic position, and from what I understand, there are some very large players in North America, US and Canada, that provide unallocated, pool allocated accounts. If you sell it all and stand for delivery, we're going to drain so much silver, physical silver, out of the global supply chain that you are going to see. So we are already seeing stress. I think that stress will exacerbate to the point that COMEX will be forced to let the price go higher. And what I should say is that when you look at what happened with the silver price last year, so July 2020 was the largest delivery month in the history of the COMEX. The first 2 weeks, the price does nothing. From mid-July to the end of the first week of August, the price runs 60%, from 17.95 US an ounce up to 29. Now, why does the price run aggressively so high or so fast in such a short amount of time? It's because that when you're in a delivery month and you've got to come up with silver at COMEX and you don't have it, the price goes higher to attract new sellers. So what we need to do is to basically keep the demand up, obviously deny COMEX physical ounces. So when they have to deliver, for example, in the next big contract, which is May, if they don't have enough silver to meet their contractual obligations, the price will run to attract new sellers into the market. and that's what we have to do. But I'm of the firm belief, and others in the industry are of the firm belief as well, is that there is enough money in the global retail market that if all of us acted in unison, we can basically stop this international syndicate from continuing to suppress the price of silver.
I just want to go back and touch on something you said there, John. You were saying that the COMEX, if demand continues like this, they might have to let the price rise. So is this because they're going to try to dampen demand by letting the price rise? And as a downstream effect of that, what's this going to do to the banks that are holding these short positions on silver?
Well, no, yes. So, and I mean, like, so I'll give you my point of view, but obviously, David is the bigger expert. But so basically, when you don't have, and I should say, this is exactly what happened with palladium. So when you have a contract that says you must come up with silver or palladium, and you don't have it, well, how do you get it? The price must rise to attract sellers. So now when the price goes up, that does attract supply to be sold into the market, but it also then does actually attract additional demand because people start chasing the price. So the price, if they don't have enough silver, the price will go higher in order to basically get enough silver into the market to meet demand. And obviously, when we reached an extreme position in palladium a couple of years ago, the price went up 400%. Because they just were out of palladium to meet all their contract obligations. So that's, I think, the strategy that we need to pursue going forward. And so sometimes people think, well, what can little old me do to actually participate in this global effort? And I'm telling you, if you have a synthetic position, sell it, go get physical. Make sure if you take physical possession, that's great. If you have it allocated and someone's holding it on your behalf, make sure your counterparty is trustworthy and that you know for sure that they're not operating a fractional reserve allocated vaulting system.
David, anything to add there?
Yeah, a little bit. So I've witnessed this through the silver market and others, but particularly the silver market a few times. So when the shorts are in trouble, what they'll do is what I call stand aside, which means they don't add any shorts to their position and they let the market, what I call, burn out. And this is what happened in 2011 from roughly, there's no scientific study on this, but I know the market pretty well, roughly from the $35 level up to the $50 level. The banks just let it run because it's all retail buying at that point. It's very little buying by hedge funds, trading funds. It's basically the public. And then there comes a point where it basically burns out. The public has spent their last dollar on silver at 48.55 or whatever it was. I did call that top, by the way, just not out of ego, just out of, I've seen it before. I've been there, I've done that. I said, I'm afraid this is it. And I called the top regardless. So then now they know where the top is because they just stood aside and watched the market. They're very savvy about this stuff. Now the trading funds that have a pretty big position on their longs and a big profit on paper have only one thing they can do, and that's sell. When they sell, the banks sell on top of it. So now you have a lot of selling pressure. Mm-hmm. The retail people, they think silver's going to 100, so some of them will buy it at 48 and hold on to it because, anyone knows, and it is going to go to 100 in my view. But so now you've got a lot of selling pressure, and all the buys and sells have to match in the futures markets, whether it's corn, wheat, cotton, or silver. So there was somebody that's in the futures market that's inexperienced that watched silver go to 40 and then up to 48. Said, oh man, I missed it. If I could only buy silver at 40, oh man, I'd be so happy. So there's an open order sitting there at 40. And there's no orders below 48. Now I'm making this up to illustrate a point, but all orders have to match. So now you've got, 100 contracts to sell at 48 and 100 contracts to buy at 40. So since they match them, the exchange will match them up, and they'll if it's a market order, they'll just go automatically to that level. So that's where you get a gap in the chart. It's where you, and I'm making an exaggeration to make it very easy to follow from an audio rather than a video. So you get this big gap that all of a sudden no one was able to sell any silver at 48. They had to sell it at 40. And then once it starts down, it usually goes down faster than it goes up. So I hope I didn't over talk it. The point is these guys know what they're doing in the futures market. And either way, they're usually taking advantage of the public. The thing that was so interesting about silver in 2011 is they increased the margin requirements like 4, maybe 5 times. I don't want to exaggerate. I like to stick to the facts. I think it was 4 times, but it might have been more than that. And the last comment's on palladium, and I get this question a lot. David Smith wrote a great article about silver is going to be like palladium, and I think someone else did. I think Craig Hemke might have done one. A couple people have done it. The difference between palladium and silver, good or bad, is the palladium market was at the margin for industrial use. So when it went up 4-fold, basically the demand stayed at that level. And so we did what I call a half a T. We went straight up and then to the right at that high price. And of course, all of us in the silver market would love to see that. But since only 50% of the silver market is at that level that has to buy it, then we will get some ebb and flow. Someone will say, you know, I got it in at 50 in 2011. It's 50 now. I'm done. I never want to hear the word silver again. I'm going to sell my physical bars. You know, I've got 2 tons. Sell it. Get that out of here. Whatever. There won't be many of those. The problem with silver for the shorts is it's a monetary element. And if things do what they do about every 350 to 400 years, is it isn't just a discretionary purchase where I'm hedging my portfolio, where I've got real money in my portfolio. And if the stock market, the bond market go crazy, it at some point, and this is not very often, but we're at a point in history in my studied view, where you almost have to own it or you don't have anything. Mm-hmm. Venezuela is a mini set of that. So is Argentina. So as some of the other recent hyperinflations. So there is an infinite demand for money. I didn't say currency. There's an infinite demand for money. Why? Because money is gratification in the future, like eating food. I mean, I know I'm sounding a bit dramatic, but I'm making the point that most people miss entirely, is that although palladium went sky high and stayed there, on a physical demand only for industry, no one has a conception of what the panic buying could be. I say could, and I believe would be in the not too distant future based on the final phase of a major currency destruction and the end of the age of empire. And believe me, the banks are doing everything they can to get a reset before that takes place. They want to win. They don't want us to win. I'm telling everybody, do what John's telling you. Anytime you got a pool account and you got 5,000 at pool account, sell it, get your 5,000, but I've got to pay $32 an ounce for silver. Yep, that's the silver price. You pay $32.
That's the real silver price.
If you want to go into the futures market and get it for 26, be my guest, you fool. Because at the end of the day, you're going to have it or you're not.
Excellent point there, David. One of the things that occurred to me while we were having this discussion is that there's a lot of people talking about, trying to put their money into PSLV. So what are your guys' thoughts around buying shares of PSLV instead of taking and buying, exactly like you said, David, the true silver price, or the paying the premium on top of the quote unquote spot price?
Well, I trust the PSLV a lot more than any of the other silver ETPs. And it's a product that's good for some people. I mean, some people live in an apartment, they're worried about having silver in their possession. Mm-hmm. They travel a lot, or they just feel insecure having it. They don't have any place to store it or whatever. So I think it's probably the best of all the ETPs. But still, the first rule of silver investing, when I wrote that, I said, no one wants to be a prophet of doom. And in the unlikely event of an all-out currency collapse, silver will be the money of last resort, not gold. Gold will be too much value per unit to do day-to-day trade transactions. But silver will be used in the marketplace. And therefore, everyone that thinks this could happen should have a silver position where they can touch their silver. That's what I said. And I wrote that almost 20 years ago because it's true. And, you know, what I'm saying sounds extreme, and it is. And it's extreme because it happens, as I said, to the level I'm talking about every 300-400 years. It's not something that's currency changes every 40 years. I get along with, I understand that. I know what they're saying. I get that. But what I'm talking about is a cataclysmic event that happens when the synergistic things happen, where the food supply gets broken, you have weird weather patterns, you have high unemployment, you put everybody on the dole. Does it sound like where we are right now? And there's only one solution. You could print all you want. I mean, we could go into Zimbabwe and everybody gets 10,000 a week. Mm-hmm. Doesn't matter. It's what can you buy with that? Look, people say you can't eat silver. You know what? They're 100% correct. But you know what? If you're in Venezuela and you have silver, you're still eating. That's what I'm talking about. Is it going to, am I saying there's going to be starvation on planet Earth? And the answer is yes. There will be. There is right now. I'm saying it's going to accelerate because of what's happening in the supply chain and the crops around the world. I mean, you got this mice problem in Australia. You've got this locust problem in Africa. You've had flooding in certain areas. You know, God forbid the Three Gorges dams breaks. I mean, there's a lot going on that people are not really aware and awake about that could disrupt things far further than they've already been disrupted. I don't want to sound like a Cassandra, but you know, the whole story there was that she told the truth, but no one believed her, or him, whatever it was, Cassandra. But the point is, we are facing much more difficulties in the near future than people are willing to get out of their normalcy bias. And that's why John's plan is so elegant, because a lot of people have 5,000, 2,000, 10,000, 15,000 in a pool account. All you've got to do is liquidate that, one phone call, send me the check. You can even do it with some of the pool accounts. I have one. You know, well, David, why in the heck would you have a pool account? For a very specific reason. The day I bought into the pool account was for one reason. If something ever happens to that pool account, I'm on the email list. I get that letter that says, we're sorry, we're no longer able to deliver any silver out of this pool account. You'll have to settle for cash. Things have gotten extreme in the silver market. That doggone David Morgan and John Adams made things happen.
To your point there, David, I saw something the other day about the cost of living in Venezuela. And just a quick summary of it, it basically costs 21.2 ounces of silver per year to cover food, rent, and utilities. At current Sprott prices of silver, it costs less than $600 US to buy enough silver to cover a year's worth of basic necessities during hyperinflation. I'll post this chart because it's very instructive to exactly to your point of, yes, you can't eat silver, but if you have some silver, maybe you are going to be able to eat. John, anything to add here as we wrap up?
No, I think it's like what I would like to say, Tom, is the key message is if you have a synthetic position, liquidate today, go get physical. And if we do it as a global movement, we're going to actually have it place enough pressure on the global silver market that we're going to make a real big difference as to where the price is going to go. But also, when you think of the more macro picture, obviously when if you have a rising silver price, a rising gold price, it's going to wake up the masses to what's really happening in the monetary system. And the only way we're going to come to some sort of resolution with this global debt bubble is we have to wake up as many people as we can and place enough political pressure on parliaments and congresses and central banks to actually change the course of macroeconomic policy. So there is a more sort of global message to be had about how can we liberate ourselves under the ruling thumb of these elite central bankers in this global debt bubble. But when people like David and others say that silver is the Achilles heel, we really need to crack this price suppression program that they've got on. And I think liquidating synthetic and buying physical, that is the thing that we as small individuals can do. And the only thing I will say is that I am trying to start to keep a bit of a tally. If people are liquidating synthetic and buying physical, I would encourage people to email me at john@adamseconomics.com. Doesn't matter where you are in the world. I'm very interested to hear stories around the world about people selling synthetic, buying physical, and hopefully we can. I've done 14 tons already, and I'm only just a small fish. If we get this into a global movement, maybe we can sort of hit 50, 100, 150 tons, and we can really impact where COMEX is going to go.
It'll help give us some data on how this actually happened, right?
Absolutely.
David, anything else to add as we wrap up here?
No, just it's fun to do 2-on-1. I don't get to do it that often because, steel on steel, we each sharpen each other, and hopefully it was complimentary. I hope that my little digression into the Goldsmith story was good. I think for first timers or people that are just now waking up, it's a very easy story to understand, and that's basically what happened. And when you go back for that receipt and say, hey, I got a receipt for my gold, and it's not there, it's a metaphor and an analogy to what's happening now. And like John says, you have the ability to take that receipt, turn it into fiat, take that fiat and go to a dealer that has it, pay the premium. You're getting silver. That's what we're talking about. We're talking about what's real and what isn't real. The whole market has been rigged to what's unreal is determining the price. It's time that enough people wake up and say, I want what's real. What does it cost? Oh, that's the cost. And that'll do it. I guess one final comment, and it's a bit self-serving, is one factor we haven't put in is the blockchain and precious metals-backed cryptocurrencies. I think that is going to be a way that no one has really thought that much about. I put in some effort into it, that a lot of people in, let's say, Indonesia, Africa, parts of Asia, that don't have access to a bullion dealer or the Perth Mint or anything, that can buy through their phone and purchase silver at a gram, $2 each or $2.50 for a gram, are going to do it once they understand the benefits of owning precious metals. And that, I think, is where the millennials will come in, and they can adapt to it very easily because they're used to doing everything off their phone. So there's that aspect too. And I think to make a summation of what I was saying about the difference between palladium and silver is that when you get into what I consider the run to gold, which will spill over into the run to silver, is that the price will exceed that of what palladium will do, where it's settled around 2,500 an ounce US round numbers, because there's very few participants in that market for investment purposes. Even though silver is only 50% industrial, as I said earlier, but I want to emphasize, there's an infinite demand for money when you realize that's your lifeline. That's something you have to have. And if you don't, So that will take the price probably in the past from history, we know, to astronomical levels. So when I did that video on my weekend update a couple of weeks ago, and I said, is silver worth $400 an ounce? I showed as a matter of fact that silver was $400 an ounce in purchasing power between 1344 and 1544. So for 200 years, silver purchased $400 per ounce. Does that mean it's going to be $400 per ounce in current currency or not? I don't know. It might be 800. I'm not saying that. I'm on record for saying 100. I think it's triple digits, almost guaranteed. Mm-hmm. And I think it could easily double that. And so you're looking at somewhere around, 7-fold increase or something from right now in value. We really don't want to get too hung up on the paper price because it becomes meaningless, especially in a high inflationary environment. What we want is what you said, Tom, and you're going to put into this back and forth, is what it is in Venezuela. You look at that chart and say, man, are you kidding me? And that's why I said, people say, well, how much, silver do I need? I say, you know what? If everyone that understands what's really going on bought 100 ounces, you're in great shape. Because from my study, if everyone did that, of course they can't, but if everyone that woke up did it, that would be enough of a drain on the silver supply above ground that those that did have that 100 ounces would probably have 6 months to a year's worth of purchasing power.
Mm-hmm. Excellent, guys. Well, like you say, you need to hold silver in your hand, right? Guys, thank you very, very much for your time today, and have you back anytime to give us updates as this progresses.
Thanks, Tom.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.